Hey everyone, and welcome back. Today we're diving into a brand new explainer, and I'm absolutely thrilled to have you here as we unpack some seriously intense market dynamics from the week of June 22nd to the 27th. We're going to completely bypass the noise today and look directly at the data to figure out what's really driving the foreign exchange market right now. If you've been watching the charts this week, you already know we've seen some massive moves. So we're going to break down the overarching themes, dissect the core drivers, and equip you with exactly what you need to make sense of this wild landscape.
Okay, let's dive into this. Here's our macro to micro roadmap for today. We'll start with a weekly Forex market overview, move to the dominant US dollar, and check out the non-US currency weakness. Then we'll do a deep dive into the British pound and wrap things up with a future market outlook.
All right, let's start with the big picture. Section 1, Weekly Forex Market Overview. Moving right along to Section 2, the dominant US dollar. So as the core driver of the entire market right now, the US dollar didn't just have a strong week, it had a totally defining week. I mean, the dollar surged to a near one-year high. It was the undisputed king of the hill. But why? What's fueling this massive ascent? Well, it's pretty much entirely driven by the Federal Reserve's hawkish interest rate outlook. The market is aggressively pricing in the reality that the Fed is not backing down anytime soon. And those expectations of tighter monetary policy and higher yields? They're acting like a giant magnet, pulling global capital straight into the US dollar.
To really get a feel for the dollar's dominance, you kind of have to look at its weekly rhythm. It wasn't just a straight line up. It dictated the pace of the entire global market. Wednesday, that was peak strength. It set the whole tone and put incredible pressure on every other asset class out there. Then on Thursday, we saw a brief, slight pullback, a tiny breather for the market. But by Friday, the dollar stabilized and held its ground. This wasn't a flash in the pan. This strong structural pattern persisted and completely commanded the week's trading environment.
Which leads us perfectly into Section 3, Non-US Currency Weakness.
And this brilliantly illustrates what happens when the dollar reigns supreme. Everything else just feels the squeeze. Look at the collateral damage here. Starting at the top, the New Zealand dollar, the Kiwi, was literally the bottom performer this week. It got hit with a double whammy, a super strong US dollar, plus weak commodity prices. Moving down, the Canadian dollar, the loonie, was battered to a 14-month low against the greenback, directly pressed by those aggressive Fed rate hike expectations we just talked about. Then we have the Swiss franc. Now, normally you'd expect the franc to hold up as a safe haven during uncertain times, right? Not this week. It essentially lost its safe haven status because global funds bypassed it entirely, flowing straight into higher-yielding US dollar assets instead. Finally, the euro. Absolute roller coaster. Highest volatility of the bunch, it had a brief peak early on, followed by a rapid dive, and just turned into this fierce, multi-directional battle between buyers and sellers. It was a chaotic week for anything not named the US dollar.
All right, let's get micro. Section 4, British Pound Deep Dive. To truly grasp the complexity of this market, we need to look at a specific protagonist. The pound presents us with a super fascinating mystery right now. Over the course of the week, the British pound fell over 1% against the dollar, dropping to near two-month lows. Sounds terrible, right? But here is the paradox. When you look at a basket of non-US currencies, the pound actually showed positive relative strength. It essentially outperformed the euro, the Aussie, and the Kiwi. So, how on earth can a currency be incredibly weak against the dollar, but actually relatively strong against its peers?
Let's peel the onion here and see how this builds. The pound's current valuation isn't just one simple story. It's being driven sequentially by three distinct layers. First, we have immediate political and technical factors. Beneath that, the really heavy, fundamental layer of policy divergence. And finally, a hidden, overarching layer of geopolitics. Let's break these down one by one.
So, Layer 1 is the immediate surface action. This week, we saw local UK political risks rise, which inherently adds a risk premium to the currency and pushes it downward. However, by the end of the week, short sellers were just exhausted. The currency was in a deeply oversold condition. This sparked a fragile technical rebound on Friday, June 26th, allowing the pound to briefly poke its head back above the 1.32 mark. But keep in mind, a technical bounce from exhausted sellers is very, very different from a fundamental recovery. So the crucial point is Layer 2. This is the heavy fundamental gravity pulling the pound down, and it's all about policy divergence. Look at this stark contrast. On one side, you have the US Fed broadcasting hawkish signals with aggressive rate hike expectations rising by the minute. On the flip side, you have the Bank of England, which is essentially pausing. Their pace of policy tightening is significantly lagging behind the US. This massive gulf in interest rate expectations is fundamentally draining capital out of the UK and funneling it straight into the United States. That's exactly why the pound broke below the 1.33 handle last week.
And then we uncovered the hidden third layer, the geopolitical safe haven impact. Now, you might be asking, wait, what do Iran peace talks have to do with the British pound? Well, absolutely everything when it comes to global risk sentiment. The market had been pretty optimistic about these peace talks. When they suddenly broke down, global risk appetite completely evaporated. Investors panicked and immediately sought the ultimate safe haven. And as we discussed earlier, that safe haven right now is the US dollar. So this geopolitical shock inadvertently hammered the pound as funds fled riskier currencies and rushed back to the safety of the greenback.
The original source material summarizes the pound's plight beautifully with this quote: "Old logic sets the base, plus new bearish factors add pressure." The old logic is that massive monetary policy divergence between the Fed and the Bank of England. That set the structural base for the pound's weakness. The new bearish factors are the rising UK political risks and those geopolitical shocks, which simply added way more downward pressure. What this ultimately means is that Friday's little price bump was just a technical fix, a temporary band-aid, and absolutely not a trend reversal.
Which brings us to Section 5, Future Market Outlook. Having dissected the macro forces and the micro details of the pound, what should you be watching next week? To stay ahead, you need to monitor these 4 key indicators. First, pay close attention to central bank policy statements and rhetoric. Any tiny hint of a pivot is absolutely crucial. Second, keep an eye on core macroeconomic data releases. They're going to either validate or totally challenge the central bank stances. Third, watch the ongoing geopolitical dynamics, particularly anything that could trigger sudden safe haven flights. And finally, the most important driver of all, watch for any shifts in the U.S. Federal Reserve's hawkish expectations, because as long as the Fed stays aggressive, the dollar stays strong.
Which leaves us with this massive, overarching question to ponder as we head into next week. Will the US and UK monetary policy gap finally begin to narrow, or will these local political risks ease up? The fate of the pound, and honestly much of the non-US currency basket, hinges entirely on the answer to this exact question. Keep your eyes on the data, folks, and watch how these converging forces play out. Thank you so much for joining me for this explainer. I hope this structured look at the week's market mechanics gave you a real edge. See you next time.